Today, you're learning all about the short strangle option strategy, what it is, how it works, how to set one up in a real trading account, how to defend your position in case things go awry, and how to set stop losses on short strangles. It's all here right now. So a short strangle right here inside of Interactive Brokers, we're going to use this on the QQQ, the NASDAQ. And what it is, when you pop open your options chain, a short strangle involves, going to go out in time a little bit here. Let's go out to the September 15th. 15, 16 days away. When you're doing a short strangle, you want to go ahead and sell. You're selling both a call and a put option on the same expiration date, but at different strike prices. The idea being you set this up and you pick one of these strikes to sell below or out of the money from the current stock price. QQQ is right around the 376, 377 area. So we would want to go out of the money. And if I was going to do this, let's go with a delta of about 20 to give us a 20% chance this side will be approached in the next 16 days. A little tip on the delta for you there. You can sell that. If you do a strategy builder, we'll build in both sides of the equation here. Let's do that one again. 20%, 367. And on the call side, I'm going to do the exact same thing. I'm just going to flip down here and not really worry about the strike price aside from it being out of the money. I want this to be above the stock price on the call side and below the stock price on the put side, out of the money on both sides, so you're not actually on the hook for anything. We're going to do this one right here. And when you combine to sell both of these options, you in turn create a short strangle with a put and a call. You're selling or you're short both. And then the combined premium or bid ask there is what you get paid right away if you execute this trade as the seller. So in this scenario, the mid price here between all of the premium that is available to me is 307. That's your potential profit right there, is 307. Now that's how you set one up. Once this trade is initiated, if we go into our advanced tab here, you have the ability to, again, make a total amount of 305 after commissions, 307, 305. Not a bad return. However, you are taking on unlimited potential risk in this scenario by having both selling options on either side. Why would somebody do this and have a max loss of infinity? Well, because the profitability is 72%. And hey, $300 is a pretty good return for a minimal kind of margin impact on the account. That is why. And you can always defend your trade if you wanted to. So to exercise this trade inside Interactive Brokers, I just move my face up there in the right-hand corner. It's the submit order button. That would go in the hopper and we would be good to go under our next position. Down here, it's going to be in there. It's going to get filled once you're in live market trading hours, and that is going to be in your account. But I have one in my account already, so let's switch over to that. And there it is right here. We've got the short strangle on the SPY right there, again, made up of a put and a call. And you can see that these are both 444, 458. The current price right there, the underlying is 451. So they're on either side. Again, I sold a call and I sold a put, both out of the money. I'm getting paid combined about $400 to make that happen. What happens though if the stock price starts to move in the wrong direction and starts to impact one of these 444, let's say it goes down to the put? Well, you got to play a little bit of defense. And based on where the stock price for the SPY is right now, you know, maybe it's going to go up a little bit more, but ideally in a perfect world with the short strangle, the stock price is going to be kind of in a neutral zone. So maybe for a SPY strangle, you want to take the bottom zone right here at 430 and go up here to the 458 area. And that's where you set your strangle. Because once it approaches one of these, you have to make a decision what you want to do. If this was to turn face and start heading down lower towards our strike there around the, again, what are we at there? 444. We have a couple options, okay? We can get in here, and if we want to, we can just go ahead and take this put. If this gets approached down to 444, this number is going to go negative, and it's going to go negative quickly. And that's going to start creating a negative kind of return for your position. The short call there is going to be going positive, but not at the same rate. So you're going to actually be down in your position if one of these sides, in this case, the put gets approached. So as it gets approached, it's going to be changing in value. This is going to be a red negative number, and you're going to have to make a decision. You can click this. One thing you can do is roll this out. When you're rolling, you would close down the 444 strike, and you'd have to get a little bit closer to the money in order to make this happen and keep it as a short strangle. If you want to do this, you could click the 446 and roll to there. If you were to do that, then you'd be closing down the 444. You'd be taking a little bit of a capital loss on that. You could then tighten up your strangle by then selling the 446, offsetting a little bit of the loss in premium and taking in another 241 in total premium for the trade, which would hopefully help balance out a little bit, but your spread is a little bit tighter now, so it's going to be a little bit more challenging. And if the stock continues to kind of roll down towards this area, you may have to close this leg altogether. Or the other thing you can do for some protection, if this does get approached here at the 444 put, you could also go back into your SPY and you could add some protection in the form of buying a call. Okay, we have the 444 SPY on. And if we go down here to September 15th, make sure our expiration date's the exact same. It is the September 15th. Perfect. So we want to go in here, pop this open. And instead of having just this 444 right here, that's our position right now. If we went ahead and bought below this, we're going to turn this off and bought below this at the 440 area or 440.39, you would be capping your downside loss by buying this call. So you could do that, put that in there. It would then shoot into your account. It probably wouldn't get added to this position here inside of Interactive Brokers. It may, depends how it configures in, but you would then have some downside protection if the put was approached. If the call was approached, you do the same thing on the call side. You've got this call option here of 458 that we sold. So in this case, we want to just buy a call option above 458, maybe the 462 range. You buy this and you lock in some protection on the upside in case the upside is challenged in terms of where the stock price decides to go. The ideal environment for this, again, is that the SPY stays kind of flat or relative, and this works extremely well when there is a lot of volatility in the market, when you sell the position, and then that is deflated and the stock price kind of moves again in this kind of range-bound area. But a deflation in volatility when you're selling it is absolutely key. If the stock price even kind of goes up and down a little bit and meanders, that's absolutely fine. You're getting paid because of theta ticking by. You're getting paid because of volatility crush as well. And that's an optimal way to profit when you have a short strangle. So what if you want to put a stop loss on this strangle? The easiest way to do it, if you didn't do it when you first entered the position, is to click right here and then go to close. And this is a little bit confusing because it's all negatives and positives and it kind of goes back and forth. What you have to look for, again, is the amount of margin being transferred and the amount going in and out of your account. This is the quick and easy way to do it. So originally, it says we bought it, so we want to sell it. And here, if you go to close, right? Close is always going to load up your position and show you the right way to get out of the trade. We want to click on stop order so that when this actual price of the strangle itself, both legs combined, hits this kind of stop area right here, we can then go ahead and get out of the trade. And this order we want to be bigger than the 398 that we got paid. So if this inflates, it means we have to give back profit plus some of our own cash. So if we want to go to 498, we'll do that. 498. We want this to be good till canceled. And then we want to go ahead and click on the advanced tab. And this is where we want to check on the margin performance area right here. Once we do this, what we're looking for is, again, to have a debit into our account, which is correct. And as long as you see the debit going in and your account balance would be going from a large number to a smaller number, and this number here is the change is negative 501. That's what you want to see happen here with your stop loss, because if you were to get stopped out, you'd be losing a little bit of money. Okay, we got paid 400 in total, right? Our amount at 498 right here, just look back to it, is $100 more than the total of 398 right there with the negative symbol. So we would expect this 498 to be about $100 more than 398, which it is. And we can confirm this again by seeing the margin performance area right there, 499 change. That's exactly what we want to see. We give back all the original premium we got paid plus $100 more. And then your margin is also getting wiped away. And as long as these numbers are negative, and the margin's also decreasing in your account, you know that you are doing it properly, and you can override and transmit this order to put your stop loss order in for your short strangle. If you don't want to do that, you can do it also individually by each leg of the contract. You can go right click and you can actually do it here and go trade and create a target or stop exit and took the stop loss in this kind of area right here. This way you're doing it for the actual leg. You have to do it twice, one for the put leg, one for the call leg. But you can also choose to do it this way. And if you want to learn more about how to select stop orders this way with these individual legs, check out this video right here where I walk you through it. Other than that, this is the best kind of way to profit again when volatility is high and decreases, when you expect the stock not to really move too much, but you have to be able to defend yourself if it does. In the worst case scenario is you roll or you close a side for the leg, take the loss, keep going, use a stop loss, protect your capital, and keep on trading. If you got some value out of this video here today, want to know more about options in general, check out my course online at tradingoptionsdaily.com/options academy. $50 currently, half off, everything you know about basic option trading, all in one shot, all online, ready to go whenever you are. Thanks for watching. I'll see you on the next one.